Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter. We're going to talk about wealth building, commodities, financial related topics, see what people are talking about in terms of what's new. Some people, they post some pretty, I'll say, big picture charts that I really like. Sometimes they talk about new news, and we can cover all of it during these clips. We do have a platinum question and answer session at 7 a.m., which is occurring right now for the question and answer session for the website. If you want to join and hop on, you can do that at a discount code August if you'd like to join. Completely up to you. And if you want to follow me, it's at finding_finance on Twitter. So let's dive in here. I'm going to give you my financial opinions on what's going on. And there's the website. So David and John, he says, if you knew you had a better than 50% chance to do better if you took a certain action, would you? More than 50% of people who switch jobs make more money. How much? The average is about 9.7% more. Is it time for you to switch jobs? And, you know, I don't know. I mean, I think it's okay to switch jobs, but I don't think you want to do it all the time. Your resume, this is coming from a hiring manager. If you look at a resume, you look at a resume almost like you evaluate maybe a potential partner. You don't want to see this person or a potential candidate job hopping every 6 months or every single year for the past 6, 7, 8 years. Just like you wouldn't want to see your partner sleep with 20 people in the past 5, 10 years. It's all the same thing. So I don't doubt this statistic, 10% more. 10% more isn't earth shattering more anyway. I mean, it is to a degree, but I think it depends on how much you make. And I think doing it, maybe job hopping once every 5 years is probably acceptable. If you're switching companies, if you're switching jobs within the company, completely okay. So I think you have to have a strategy. If you're job hopping within the company, I don't think it's as viewed as badly as it would be if you're job hopping complete company to new company to new company. It makes you look like you're struggling at that company and that you have no stability there. Most big projects take longer than a year or two to complete. And it's difficult for me to look at someone's resume and say, oh, wow, this person's been at all these companies for six months to a year. That means they haven't even completed a large project or anything like that in their life. So I just say, yes, it's probably a good thing to job hop every once in a while. And no, I wouldn't be doing it every single year. Here's Holger, good old Holger. Oops, container rates measured by Drury's World Container Index are now below pre-pandemic levels. Shipping Group, whatever, warned of a steeper drop this year in global demand for shipping containers. You know, when I look at this chart, I actually think it doesn't look that bad. I like it when it gets down to these really low levels. Maybe it needs to base out a little bit longer, but I don't know. I mean, that's generally where I start to buy is when things are bottom crawling for a little bit and then they start to turn up. And you can kind of draw a trend line up here. And once it breaks that trend line, it's game on. Boom. Is this breaking the downtrend line here? It might be. Might be one to start watching. Just do opposite of everyone else. It's basically how you make a lot of money almost. Apple, a picture's worth 1,000 words. There's your trend line for this year at least, and it's broken that trend line to the downside. We are seeing commodities start to outperform the S&P 500. I'm sure that's happening in the NASDAQ. And maybe this is turning. Maybe the whole market sells off. I don't know. We'll have to wait and see. I'd like to see what housing starts do. I want to see all that kind of data in front of me. And a lot of the times, a lot of this stuff takes some time to turn around. So, but maybe this is the beginning of that stage, especially for technology companies. Here's XLE versus XLF. So this is the energy sector versus the banking sector. Guys, doesn't that look beautiful with that inverted head and shoulders? Shoulder, head, shoulder. I think energy could do some ripping here. That includes oil, gas, nat gas, and uranium and energy service. Basically, anything with energy in its title or name or ETF, I think could do pretty well. It says, as Trader Ferg alludes to picking multi-baggers isn't hard. It's letting them turn into multi-baggers is the hard part. Some uranium equities are at or around their 52-week lows and should 10x from here. What's your favorite uranium play for a 10 bagger? Uranium is very speculative, and they are not cash flow machines. Trader Ferg, I know he likes going after a lot of the cash flow machines, as do I. And I think I wouldn't say it's 100% easy to pick multi-baggers. Um, I think what is difficult for most people is when you buy a company that's down a lot, they're going to look at the history and say, well, this thing's been going down for 10 years. Why would anyone buy this? And that's the exact reason you buy it, is because everyone is saying that. If no one owns something, usually it's pretty bombed out. If retail sector's not in it, they're usually the ones that lose money. That is, generally a good spot to look when retail's not there. So when someone says, "Oh, that's been going down for 14 years. Why the heck would anyone buy it?" That's generally the time that you want to be buying and picking up those assets. It is very hard to hold on for most people for a long time. I think that's probably the hardest thing for the majority of people. If they see their investment go down and they see something else going up, they want to chase performance. It is almost naturally ingrained into our beings to chase things, to look at the shiny object as it goes by, to go investigate the loud noise, whatever it is. They struggle. Retail new investors struggle to hold on, and they struggle to buy things that are down. That is literally what I think the majority of people need to work on. So what does that mean? It means that you need patience. It means that you need to figure out a strategy that works for you, but also that you change yourself to a strategy that works. It's the combination of those two things. The markets are going to be what the markets are, and you're going to have to adapt to what the markets are. The game will teach you the game. And if you're not winning at the game, you have to play a different game, or you have to play a different strategy in that game. Here's Chad. I want to comment on this. He says, 1 hour to get ready for work, 1 hour commute to work, 8 hour workday, 1 hour lunch, 1 hour home, 1 hour for dinner, 1 hour for homework, 8 hours for good night's sleep. You get 2 hours per day of you time. If you aren't saving and investing, this is your life until 65 plus. What I've done in my life is a couple of things. I've drastically shortened this time to get ready to work. It's 15 minutes for me. I have a 15-minute commute to work. Why did I do that? Well, I don't want to live 1 hour away from where I work. I don't want that commute time. I want to make the things I do every day. I want to lean those processes out and cut everything that is non-value added to my life. So 15 minutes, 15 minutes. I work that day. My lunch, it doesn't matter because it's sandwiched in my work day. 15 minutes home. Dinner, I don't know, probably doesn't even take an hour for dinner. And I don't do homework. I do these videos, and it takes probably less than an hour to do these. Actually, it takes longer to search for all these threads that I'd like to talk about, if anything. Sometimes you can combine that with your lunch time or sometimes during the workday, and try to do that as well. So I've got a lot more time than 2 hours, uh, even when I'm working. So the things you want to focus on most in your life are the things that you do the most of. That's where your biggest bang for the buck is. Brushing your teeth, doing all that stuff. How do you get it down to an acceptable limit where the quality is good and the cycle time is dropped? That's basically what my entire major's on, is lean manufacturing and how to lean out all of the processes. And maybe you should do a little bit of 5S: sort, standardize, sustain, sweep, and uh, whatever the last one is. What that does is you put the stuff in the same exact spot to reduce your time to find your toothbrush, to find the toothpaste, to do whatever. I just leave it all out on the top and knock it out. The Kobayashi letter, he says the median house payment in the U.S. is now $2,605 per month. This is up 19% compared to 2022 and the most expensive median payment of all time. Even more worrisome, the median house payment now is up a massive 67% from 2021 and almost about 80% from 2020. Buying a home has become a luxury. That is true. And that is one thing that I think people should focus on is your expenses. When I was looking at homes back in the mid 2010s, I wanted to lock in my expenses, and that's exactly what I did because I thought inflation was going to come at some point in this expansionary phase of real estate, and that's exactly what I did. My payments are very low compared to these that they're showing here, and that is done completely on purpose. If you know the cycles and you know all this stuff, it drastically can help you in your life and set you up from a far better vantage point than not knowing it. I will say that. It says when you're the biggest bill each month is the amount you invest, but everyone around you thinks you're broke because you drive an old car and cook meals at home. That is the flex. You know, I think it is and it isn't. One thing that you'll realize when you get older is when you're young, you've got a ton of energy. Like you can do so much stuff without any sort of, negative ramification. You can work out in the morning, play softball in the middle of the day, and move your friend's apartment in the afternoon, and not really be wrecked the next day. When you get older, you're going to get wrecked. I mean, when you're in your 40s or 50s, you're going to be wrecked trying to do just one of those activities, let alone all three in a single day. So you have to balance, I think, your expectations. You have to balance your saving. You have to balance how much money you spend based off of where you are in your life. You're not going to be young forever. And if you ask people who are very well off, let's say older gentlemen or older females, whoever, who have millions of dollars, say, would you rather be young or would you rather have all the money that you have today? And they would say, you know what, I would trade all this money in to be young again. So I don't know what the answer is. I mean, that's great that we have this, but being young, I mean, there's something to say for being young too, and the young people just don't know it. That's all. Um, and also, another thing for the argument for this is, if you drive a Mercedes versus a cheap economy car, is there really that big of a difference? To the person, to me, it's not a big difference. To the potential mate that you might be looking for, maybe that is a big difference for them. I don't know. I know some people get impressed by the cars that people drive, by the homes that people own. I do not. I'm not in that camp. I don't really care. I'm more about performance, more about enjoyment of driving the car and all that stuff. So yeah, you can go cheap and you could have nice cheap cars that are fun to drive, and I think that's awesome. And you will save a ton of money. I struggle to buy a new car or a newer car based off of the insurance costs, based off of the registration costs, and then obviously the cost of the car up front. That's where I just can't do it. I could buy a car that's tens of thousands of dollars, but going up much past 20,000 something bucks, I kind of back away from it. But that's just me, and maybe I'll be different out in the future a little bit. It says peak oil, and I think he's talking about peak oil demand, is nowhere in sight. Jet fuel demand is projected to increase 2.3 times from today to 2050. About 80 to 95% of all people alive today have never boarded a plane. The number is closer to 95% in low-income countries. So this is jet fuel demand. You can see this thing really starting to ramp up. And if you look at where we are today, 2023 is here, and then we've got basically this kind of growing, almost like a hockey stick, higher in demand. Demand does double by almost 2050 for just jet fuel demand. Do we have all this oil in the ground? I have no idea. But I'm going to take advantage of some oil investments here and just sit in them. The ones I like are the ones that can still grow in the future and still are in good jurisdictions and can grow into what I think is going to be a strong oil price environment. This is Adam. He says, home values have soared far above where fundamentals justify. There's only one question that matters. Who will absorb the pain of that discrepancy? Current homeowners, if prices correct to sustainable levels. Or it says, or future buyers if current values are artificially propped up. I don't know if this is a fair statement. The prices are where they're at based off of the fundamentals that we have today. So you can't say that something is above or below the fundamentals of today. You could say that home values are overvalued based off of some metric, but that may or may not justify that may or may not move the price of today. If we are truly in a housing shortage, we would have the same exact conditions that we have today. They raised rates because of the inflation from those conditions. The fundamental conditions are where we are today. Now the question is, are the interest rates and the affordability enough to crash the market? My answer is no, not to full on crash it. It's definitely slowing it down. Yes, things could come back or pull back, especially in certain cities around the nation or the world. But in America, with 30-year fixed rate loans and really not much pressure on foreclosures, I don't see the pressure there. So current homeowners, if prices correct to sustainable levels, and I know that he thinks that everything's priced on the margin, but there's not enough inventory to crash the market, and that's where we're at. It's going to take some time. So if it takes 2 years, you're going to be able to see this, I think, before the accident occurs. It's kind of like you're seeing everything in slow motion in the housing market. We're not going to get 6 months of inventory in 1 month. I don't think that from two, we're at like 2.5 months or something like that right now. It says, in popular opinion, I want to completely run out of money at the end. Now here's another thing. At some point we accumulate all this money and it's really just safety. All that money is safety for like if something bad were to occur, if you have a health problem, if you need, you're paying all this like absorbing amount of money for health insurance, car insurance, home insurance, all these insurances. That's really where it's going to, and it's great, and I don't plan on having money at the end, and maybe I will have a bunch of money at the end. I don't know. I'm not trying, but if you look at it, some of the things that people spend money on, they're not really gaining much in life experience or value out of it anyway. The difference between a Honda and a Mercedes, like nothing. In my opinion, it's not. So I don't know. You have to balance the line of what's worth it and what isn't worth it. That's really what you have to balance. And I think a lot of people they just spend to spend. Maybe they're trying to keep up with the Joneses. I don't know, but I spend it where it counts. I'll just say that. Gold production costs exploding throughout gold industry. Anglo Gold mines also experiencing huge increases in AISC. The world has no idea how the falling energy return on investment of oil will destroy the financial Ponzi treasury bond system. Bonds, old collateral, gold, the new collateral. And he's talking about the increase in the production costs. Those cost curves that continue to go up are going to price gold at higher and higher levels. So I know some people ask me, well, should I do physical? If you own the physical, should I even own the gold miners? I own a lot of physical. I think the physical is the safest bet and it's the most direct way to play it. If you have falling energy returns, I think the metals are going to do incredibly well for many reasons. And he describes two of them, or a couple of them. One is your cost curves are going up. Two, bonds are going to eat it, and gold's going to be the new collateral, which I agree with. So those are the reasons to own it. And the miners are a play on their margins, and perhaps the margins don't go up as much. But you could also have royalty companies that pay out greater. The problem is gold production could fall with their royalties. So you might have a drop in volume with some of those royalties. It says oil closed the week above $82, the sixth consecutive weekly gain. The price is now up 30% from the May low. Momentum is building and the oil price will likely exceed $100 soon. This will put upward pressure on the CPI, pushing the Fed further away from its 2% inflation target. Completely agree. He says, incredible, but after the last 20 months of decline, long duration tips have now had exactly 0% total return since December of 2012. 11 years of zero return in tips. That's including reinvested coupons. You can see we're coming back to a support level, though. We're right at that support level, so we'll see if that support level holds. This could also be a much larger correction that dives a lot further to the downside, depending on inflation and how people view our bond market. Warren Pye says, nothing pointing to an imminent recession in today's jobs report, but the housing industry lost 5,500 residential construction jobs. And that is a big deal. The worst is, this is the worst monthly jobs loss post-COVID. At that pace, we should be on recession watch next summer. 8% drawdown if we were to come back. So you can see these guys generally pull back in the construction declines before a recession. So if we do see a pullback for maybe this next year, we should be able to see it on the residential construction declines, the housing starts, and all of those things will show us that. We can also see it in the inventory levels of existing homes. But right now, I think it's too early to say that with any sort of certainty. Tavi says this is not the time to be fooled at the behavior of silver prices, as it remains on the cusp of a major breakout. The Fed can only tighten monetary conditions so much, and with twin deficits in the double digits, policymakers will inevitably be forced to allow inflation to exceed historical norms. Tangible assets and quality resource businesses are likely to emerge as the prominent beneficiaries of this macro setting. As the gold to silver ratio currently stands at 82, marking one of its highest historical levels, it implies that the silver is one of the most attractive parts of the commodities market, even from this perspective. And we can see a breakout of silver. Silver, platinum, they're all good guys. I like them all. Here's another one that's really important. It says one of the worst mistakes you can make is switching into and out of stocks, hoping to avoid the upcoming correction. In trying to time the market to sidestep the bears, people often miss out on the chance to run with the bulls, says Peter Lynch in his book. Completely agree. And that happened to me last bull market, not this bull market. I'm staying invested. I've told everyone this, and some people still in comment section, oh, we're going to have a recession. You should time that. It's like, guys, I'm not, okay? When it does come and when I see all of those indicators start to turn, then I will. But we're not there yet. It takes time. You have to sit. And the hardest part is sitting in these, it's just sitting, doing nothing. Don't be trading around. Don't be switching stocks. Oh, this and this and this. I just sit. All right. It's not that bad. It says these charts suggest that major government bond yields could double from here. That is a simple projection of flag formations. The time machine is taking us back to the 1970s when the Fed funds rate went from 5 to 19% and gold went from 35 to 850. So there's all the pennant formations, and we could see a big move potentially in yields, according to Alistair McLeod. Here's uranium. This is uranium versus the SPUT, and this thing just looks ready to rip, guys. Go uranium, man. I am ultra bullish on uranium right now. Hopefully I've got enough allocated to it to make a difference, and hopefully it rips and makes everybody in uranium happy. Here's the gold versus USD chart. You can see this red line that's 1, 2, 3, and then the fourth break. 1, 2, 3, and then the fourth is the break. It's the same type of consolidation that we've got, and hopefully we get a breakout to the upside. I think the market conditions for that breakout are coming. It's when the yield curve inverts and then it uninverts. And that generally happens. I think we got maybe like a year, 6 months to a year before that. I think we get a huge rip. It could also happen earlier depending on the deficits that we're running and if they decide to do QE. If they do QE, it's game on like Donkey Kong, guys. And commodities are just going to rip. And I don't know if they're going to do that. I mean, they're really going to they're going to rip so hard if they do that. So we'll see what happens there. But that's the last one there. That's where I'm going to end it. Give me a thumb up for the content, guys. Subscribe to the channel, subscribe to the website. And yeah, that's all I've got for today. So we'll catch you next time. This is Finding Value.